All right, guys, we're going to try to do this a little bit differently than we have been doing. Um, just give it a shot, okay? Doing it kind of independently. Um, so this is the last unit here, and it's an important one, but it's not a big one. I know this outline here looks pretty intimidating, but it really doesn't take that long. I usually take a day or two in class to go through it, practice it a little bit, and quiz, which is what we're going to do. We'll probably have a quiz by the end of the week over this, combined with the Phillips curve stuff we've been doing. So this unit is about international trade. So if we looked at that circular flow diagram, where I said that is basically the whole class, where you have all those people buying goods and services on one side. On the bottom is that exports and imports piece, which is kind of what we're talking about here. So the first part here we're talking about is balance of payments accounts. So this is something that you guys are all somewhat familiar with. It's just the idea that we buy stuff from other countries and they buy stuff from us. And there's a balance of money going to and from these countries. Now, these balance of payments accounts are broken down into two subcategories. The current account is the one you probably hear about, where we're talking about goods and services. So we buy a lot of stuff from, say, China. We buy a lot of Chinese goods, right? That would be our imports from China. And they buy some stuff from us. That's exports from us to China, right? Definitely, we buy more stuff from them than they do for us. And this has been in the news a lot lately with the whole tariff situation. I think they're currently paused right now. But you may have seen in the news, the president was up at a podium and he had a chart that had all the countries, and it had the tariff we were imposing on them, which tariffs are just taxes for importing their things, paid by the receivers, paid by the people who are importing them. So if we put a tariff on Chinese goods, China sells us their stuff, and then the people who bought those stuff pay a tax on it, so the price goes up. It showed that chart that Donald Trump was showed the tariff we were imposing on them and the tariff they had imposed on us. But it was a little misleading because that wasn't a tariff that they had been imposing on us. They were using the trade imbalance to show that they aren't buying our stuff, that we are buying more of their stuff. They're not taxing us on the stuff that we are buying from them. It's just we're buying more stuff from them. So that tariff percentage was a little misleading, but I don't want to open up that can of worms. But it just has been in the news a lot, so I wanted to talk about it briefly. But this current account is one of the sub-accounts of the balance of payment accounts. And this is the one that's all those goods and services, like I was just mentioning. You buy hats, shirts, shoes from China, and they buy stuff from us. So the parts in green here is the money we get, which, by the way, my wife just took the dogs for a walk, one of them. The other one's very jealous, and he's waiting for them to come back. So I'm going to pause while they come in so that you don't have to hear my dog barking. All right, so they decided to take the long way around. I saw them walk past down the street some more, so I've got another 10 minutes or so. So exports is stuff that we make here in the United States that we send to other countries, and that counts as a positive for us because we are getting money from that. So the Chinese government buys stuff from us, we get money, right? There's also this idea, it's called income receipts from other countries. I just changed it to money from assets in other countries. So this would be, the book gave an example of what if I bought a golf course in wherever, in Ireland, right? I buy a golf course in Ireland, people use that golf course, and then that money comes back to me. So this is more like the services piece. So the exports is more like you export goods. This income receipts is more like I offer services in another country for which I get paid, right? And then I'm getting the money. Ramus, he's getting very excited because he saw them walk by. Come here, Amy. Come here. Come here. Come here. Okay. The opposite is imports, where we buy stuff from other countries. So this would be us buying the stuff from Japan or China or Thailand or wherever. We are giving them our money and they give us the stuff. So that's why it's red. It counts as a negative. Same thing. Income payments is just the opposite. Someone in wherever, Germany could own a golf course or a hotel in the United States from which he earns money. So that is money leaving the U.S. and going to him for the services he offered. And then this last one is net transfers. This is just simply sending money overseas, just like giving money. This would be like I have a aunt in South Africa, right? And I just want to send her $100 for her birthday. That is money leaving the U.S. and going to another country. And it's also in the form of like humanitarian aid, where the U.S. government sends billions of dollars to other countries to help them out. But that's why I have it in red here. Typically, it's just red for the U.S. because we often give more money to other countries than we receive. Hypothetically, it could be green because they could be giving us money. It's just that's not usually how it works out. So that's why I put it in this red. The other side is the financial account, or sometimes called the capital account. This is financial assets. This is other countries buying our stuff and us buying their stuff, but it's not goods and services, it's financial assets. So, again, the green would be us getting money. We would own assets, or they would buy our stuff. They would buy our bonds, right? Someone in China would buy our treasury bonds that the government gives out. That's us getting money and them owning the assets. It could also be that they buy stocks. Foreign countries can buy stocks in U.S. companies, right? So if I start up a company, I could sell my stocks to a Switzerland, a Swiss person, right? So that would be money coming in. And then you do it the other way, where I can go invest in a Swiss company, and that's giving them my money, and I own their asset now, their stock, right? We also see these terms called inflows, which is money coming in, and outflows, which is money coming out, right? So whenever we see this chart, the green are inflows because that's money coming into our country. The red is outflow. So just a couple of vocab terms to keep in mind if you see something asking about what happens to inflows or what happens to outflows. The other thing to keep in mind is these two sides have to be equal. Okay, so keep in mind, I saw a video that explained it pretty well that talked about China and the US, right? We export. Okay, so they got back from their walk. Let me pick up from that. We import more stuff from China when it comes to goods and services. We buy more of their stuff than they buy of our stuff, right? So they have a lot more money in that regard. They get US dollars from us because we buy their stuff. Okay, so they have all these US dollars. What are they going to do with those US dollars? They could just put some in their reserves, but that doesn't really do them any good. So what they do is they take those US dollars and they buy our financial assets. They buy our US stocks and bonds, typically bonds. That's why when you hear that China owns so much of the US debt, that's usually what happens. We buy all this stuff from China. They have our dollars and they turn around and buy our US bonds with those dollars. So we have a negative in the current account, right? Because we're importing a lot more than we export. But in the financial account, we have a positive. So they balance each other, which is what the whole idea here is with this concept, this balance of payments accounts. Okay. So here is an FRQ from 2008, I want to say. This says balance of payments accounts records all of a country's international transactions during a year. Two major sub-accounts in the balance of payment accounts are the current account and the capital account. In which of these accounts will each of the following transactions be recorded? So we got those two sub-accounts, capital account, current account. This capital account is also the financial account. I think they call it financial account more now, and this is an older FRQ. So a U.S. resident buys chocolate from Belgium. Is that going to be in the capital account or the financial account, or is that going to be in the current account? So that is us buying a good, just straight up buying something from Belgium, right? So that's going to go into the current account. Part two, a U.S. manufacturer buys computer equipment from Japan. Is that going to go in the current account or the financial account? Well, this is not a financial asset. This is not a stock or a bond. So again, this is going to go in the current account, which I feel like College Board was trying to trip you up that year by giving you the same answer twice, because you guys always get freaked out when it's the same answer twice. B, how would an increase in the real income in the U.S. affect U.S. current account balance? Explain. So that one's a mouthful. But it's basically saying people in the U.S. have more money. Their real income goes up. So people working in the U.S. now have a higher income. What's going to happen in the U.S. account balance? Well, in this case, we're going to have more money. So what are we going to do with it? In the global economy, we're going to buy more of their stuff. We're going to spend more, right? If we buy our own stuff, that's not balance of accounts, because that's not imports or exports, right? But if we have more money, we're also going to buy more of their stuff. So in that case, our current account, which is the one it's asking about, current account balance, is going to move toward deficit because we're importing more than we were. Okay. So it says explain, which I kind of did, but you basically would just say real income goes up in the US, which means we buy more of their stuff, which is going to be higher imports, which will cause the current account to move to a deficit or negative or whatever you want to put there. Part C we haven't covered yet, so we'll come back to that here in a minute. So that's the first part there. Not too bad. Just some kind of terms and some stuff you already knew, but just put in some technical definitions and stuff with it. The next part is that new graph, right? And this is, again, it's not that bad, okay? So you see this, it's called foreign exchange market. Sometimes you just see Forex abbreviated. So the whole idea, the whole concept behind this is if you want to buy foreign items, you need foreign money. So if I want to buy some stuff in Germany, I think Germany uses the euro, you need to have euros. So let's just imagine a simplified economy. This was straight from the book or the video or something I saw years ago, but I thought it kind of made sense. And again, I played around with my silly mug shots, fell down a rabbit hole looking at silly pictures. So imagine this lady. This lady right here has 1,000 euros, and that's it. Let's just imagine that's all the euros in the world that exist, just to simplify it, make it make sense. She wants to buy US dollars with her euros because she wants to buy something in the United States. Okay. Well, enter this guy. He has $1,000 and wants to convert it to euros. So she has 1,000 euros and wants dollars. He has $1,000 and wants euros. They can trade. They can buy each other's currency, right? She says, okay, I'll give you my 1,000 euros or she says, I'll give you my 1,000 euros for your $1,000. And he agrees and everybody's happy, right? But then what happens if more people want euros? Let's say this guy comes in and he has $1,000, but he also wants euros. Well, now she says, hey, both of you want my euros. My euros are in higher demand, so I can charge more for them. So now suddenly the euro costs more money in terms of US dollars, right? And then another person comes in and says, I want euros and I have dollars. And she says, okay, now everybody wants my euros. I can charge a lot higher price for them, right? So this is that idea of foreign exchange, okay? That idea of an exchange rate, that in an exchange, the exchange rate will go up for euros because more people want to buy them, okay? And if the opposite impact happened where nobody wanted euros, then the exchange rate would drop, right? Which we kind of see happening currently with the whole tariff situation. The exchange rate for the U.S. dollar is depreciating because people aren't buying as much American stuff. Mr. Clifford, who you guys know from ACDC Econ, he tells a story, and I think I've told it in class before, where he used to offer Clifford bucks for doing stuff in class. He printed out, we watched the video of Shroot bucks from The Office. He printed out Clifford bucks with his face on them, and I don't know what you could trade them for. I don't know if it was like homework passes or special privileges in class, but he was giving them to his students, and his students actually started buying them from each other with US dollars. Like they would say, hey, I need some Clifford bucks. I want to do this thing. Can I pay you $1 for your one Clifford buck? Right. But then something happened and the Clifford bucks got more popular. Kids wanted them more. So then they became worth more in US dollars where they're like, hey, I want a Clifford buck. Well, now you have to pay me $5 for one Clifford buck. Right. So he created this functioning exchange rate in his classroom, which he had to shut down because it got out of control because, parents would get real upset if I started offering dollars and kids were buying it with their real money, and it would be a problem. But I didn't put him on here because he's huffing paint like a lot of these other people in the pictures. This guy on the bottom right, actually, he was arrested. I don't know what for. Nothing serious, I think, but someone saw his mugshot and saw how beautiful he was, and he got a professional modeling career from that mugshot. So anyway, there's the side story. So then we get into the actual graph. Okay, now this is important labeling, like we talked about when you do your money market and your loanable funds, you have to get the labeling right. So whenever we label this, we draw a normal X and Y axis. Okay, and we're going to say this is the graph for euros. So on your X axis, same. Quantity, just like always. We put quantity of euros on the x-axis. On the y-axis, it's always the price, right? So what's the price of euros in this case? The price would be the other currency. So whenever we do the graph for euros, you always put euros on the bottom, the denominator, because it's dollars per euro. Okay, how many dollars do you have to spend to buy a euro? So you always, and it's very important, they will count you off on this if you don't label this correctly, because if you put euro over dollar there, then it's no longer the graph for the euro. Okay, so you always put the one you're talking about in the denominator. So it's dollars per euro. And then we just have our simple supply and demand because it's just basic supply and demand here, right? At higher rates, at higher prices, people want to supply more. At higher prices, people don't want to buy as much. So we have a negative relationship for demand, a positive relationship for supply. And then we have our equilibrium interest rate, right? Now, we're not going to click this link. I used to have a link on here of just silly products that should be invented. Now, let's just say that Germany invents this really, really cool product that everybody wants to buy. Well, to buy it, what do you need? To buy this product, you have to have euros. So what's going to happen to this graph for the euro if people want to buy this German product? Well, everybody wants euros. So the demand for euros would shift to the right. Well, look what happened to the price of the euro. It went up in terms of US dollars. It used to be maybe it was $1 for 1 euro. And now this product came out, and now you have to pay $1.50 for 1 euro. So the term we use here is we say the euro appreciated. The currency appreciated because now it costs more. It became more valuable. Now, this is all super easy because it's just straight supply and demand, but there's always like one little trick, right? There's always one little catch with each one of these curves. Excuse me. For this one, there's another curve. There's a curve for the dollar. So we have the curve for the euros over here in terms of the dollar. Now we have to see what happens to the graph for the dollar. Because let's just say this scenario on the left happened where people want to buy more euros to buy this good, right? To buy this sweet new thing that they just bought. Well, in order to buy euros, what do you have to put up? What are you putting in this hypothetical market for currency? If I want to buy euros, what do I have to supply? I have to supply my dollars, my US dollars. So in this case, whenever the demand for one currency appreciates, people want it more. To get it, they have to supply their dollar. So if I use my $100 to buy however many euros, 100 euros, well, now there's 100 more dollars out there to be purchased. So the supply of dollars increases. So in this case, the US dollar depreciated. Okay. And it's always going to be the opposite. So if the euro appreciates, the other currency has to depreciate. Because in order to buy that currency, you have to supply the other currency, which shifts supply to the right and shifts that equilibrium down. Okay. Now, here's where College Board loves to ask. Okay. So if this happens, what happens to the demand for US products? So the US dollar has now depreciated. It's cheaper. Now, depreciation sounds really bad. It sounds like a bad thing. You want your currency to appreciate and be worth more. It means it just means people are wanting to buy more of your stuff. But think about it in this term, right? If it's depreciating, it just means the US dollar got cheaper. So what's going to happen for US products if our stuff is now cheaper? It means people are going to buy more of it. So if a currency depreciates, that means that people are going to buy more of our product. So it kind of in the long run could be a good thing, right? Because they're going to buy more of our product. But I mean, and it kind of gives you a bad signal of what's happening now when your currency depreciates because it means people don't want your stuff. They want other people's stuff, right? But once your value goes down, then people might buy more of your stuff because like, oh, people don't really want US stuff right now. So it's going to get cheaper. So you, in the long run, we'll buy more US stuff, okay? So take a look here. Balance of payments accounts record all of a country's international transactions during a year. Excuse me. I have to get a piece of paper out, see if I can draw here. Two major sub accounts. So this is the one we already did. This is the one we already did, right? So we have to do letter C here. Okay. So using a correctly labeled graph of the foreign exchange market for the US dollar. So if we're drawing it for the US dollar, how are we going to label that y-axis? We would put quantity of US dollars on the bottom, and we would put the we would put the euro over the dollar. Okay, so I did it kind of quick and easy there, but you can see euro over the dollar, quantity of dollars. We draw our supply curve, we draw our demand curve, and we draw our equilibrium, and you have to label it. I typically label it ER1 on that axis. Okay. Show how an increase in United States firms' direct investment in India will affect value of the US dollar relative to the Indian currency. So this isn't euros, this is the rupee. So I should put rupees over dollars instead of euros. I'm stuck on my example. So it's saying here that the United States firms are investing in India. They're buying Indian goods, right? To do that, they have to buy the rupee. Okay. To buy the rupee, if we were drawing the graph for the rupee, we would just say, all right, demand for the rupee shifts to the right because we want to buy more rupees. But this asks us to draw the graph for the dollar. So if we're buying more rupees, what's going to happen to this graph? That means to buy rupees, we have to supply our dollars. So we have to shift that supply curve to the right. And look what happened to the exchange rate. It went down. So it depreciated. The US dollar depreciated in this example. Okay. So that gets us to that spot there. The last piece here is the financial part, the financial capital flows. Okay. And this is where they love to do it on that number one. They love to tie it back to the ADAS and the money market graph and the loanable funds graph. Because I'm betting this is what they're going to do, because the last couple of years they've kind of given this its own question. So I'm betting this is what they're going to do this year. So this again is talking about money going in and out of countries because of them buying assets. What determines if you want to buy a US bond? It's that interest rate, right? You want to buy it when it has a higher interest rate. So let's just say in this scenario here, I have a loanable funds graph. Interest rates are 6%. So when you buy a US bond, you're going to get 6%. Okay. Let's say that Germany has a 3% interest rate for their bonds right now. So our bonds are better than German bonds in this hypothetical scenario. Okay. Now let's say that we have a recessionary gap, a negative output gap. It's going to say, what fiscal policy could they take to try to fix that negative output gap? Fiscal policy is government spending. So if we have a negative output gap and we want to fix it with fiscal policy, we could increase government spending. What's going to happen to the loanable funds graph if we have a balanced budget? If we increase government spending? Well, it could be that interest rates shift to the right. It could be that supply shifts to the left. Either way, we're going to have higher interest rates. Our interest rates are going to go up. So now look at the US bond. Now look at it. I should have animated that on the left slide. It was 6%. Now you can buy our bonds and get 8% or 9%, right? So what are other countries going to do? They're going to want to buy US bonds. What do they need to buy US bonds? They need US dollars. So that change in interest rate, which is what College Board's going to do. I'm going to give you an FRQ at the end of this, where it's going to say we're in a positive output gap or a negative output gap. Use fiscal policy. How is that going to change interest rates? What's that going to do to the value of the dollar? So in this case, I said we have a negative output gap. We increase spending. Spending shifts the demand for loanable funds to the right. That's going to increase interest rates. If interest rates increase, other countries want to buy our assets. To buy our assets, they have to buy dollars. And you can tell this is the graph for the dollar because it's euro over dollars. So if they want to buy our assets, our financial assets, they got to buy dollars, and that's going to cause the dollar to appreciate. Okay, and then it'll say what happens to the value of our exports and imports. Well, if our dollar appreciates, now it's more expensive. So it's more expensive for them to buy our dollars, which means it's more expensive for them to buy our stuff. So what would happen to our exports in this scenario? It would cause our exports to go down because our stuff just got more expensive. Okay, so you can see it's kind of a this, then this, then this, then this, then this approach to these FRQs. Okay, there is this simple part here. This would probably be a multiple choice question on my test on the College Board as far as if they want to keep exchange rates the same. A lot of the times you see in the FRQ, they have a floating exchange rate, which just means it's determined by supply and demand. They just let it do what it's going to do. Okay, the exchange rate is just kind of going to go up and down with depending on how the economy and the world economy is going. But some places want to keep theirs the same. I don't know specifically in a real world example of a country that uses this, but they try to keep a certain exchange rate or peg a certain ratio is what it's called. So let's say if you look over here on the graph and we have that exchange rate at that equilibrium and they want to keep it there, right? Well, let's just say something happens and demand for the dollar increases. What could they do to get it back to that old exchange rate? Well, they could change interest rates so that people don't want to buy our stuff anymore. They'd say, well, our currency is too expensive. People don't want to buy our stuff. So we need to get our exchange rate back down. Well, let's just lower interest rates. Then people don't want to buy our financial goods. So the demand curve would shift to the left. Or they could say, you know what, let's just buy another country's currency because we could shift demand to the left, but instead, what if we shift supply to the right? That would be us buying other people's currency because remember, to buy their currency, we have to supply our own currency. So that would shift supply to the right and get us back to that lower exchange rate. Or they can just, there are something called licenses where they just limit how much you can buy of our currency. You don't see that too often, but that's just like limiting how much people can buy of our currency, which would kind of create that demand on their own. They could kind of handle the demand because it doesn't matter what demand is. We're not going to let you buy it, right? So that's more of a multiple choice type question there. Okay. And then here we go. Finally, our first complete number one FRQ. I've told you when we do these number one FRQs, it's always like I had to take parts out because we haven't covered that yet. But this is what a full-fledged number one FRQ looks like because you're going to draw ADAS here, right? You're going to have the foreign exchange part here, okay? You're going to have open market operations is on here, right? So this is a little bit of everything on here. So take a look at this one. Give it a shot. I'm going to try to make a separate video where I go through and answer this one on a Canva. Okay, so hopefully this helped. If I went too fast, you can go back and rewatch a part. So that's kind of the idea here, that if you're getting confused and left behind and afraid to say anything in class now, you can go back and rewatch that section. Hopefully I didn't say anything wrong. If you're confused, please ask me, come get help, come to Flex. Okay.